Hi there. What we wanted to do is give you a quick glimpse into our morning meeting with our key takeaways after a week of central bank meetings last week. So starting off with South Africa, we saw our MPC raise interest rates by 0.25% to 4%. So just to give us some context there, we'll remember in the COVID crisis, we saw interest rates drop significantly to 3.5%. Those were really emergency levels. So we haven't seen interest rates there for 4 decades, for 40 years in South Africa. We always knew that those were emergency levels. They'd have to be raised over time back to sort of a more normal level of interest rates in South Africa, which we would say would be somewhere between 5.5% to 6%. So the question was, how quickly would rates have to be normalized from that 3.5% level back to round about the 6% level again? And when the MPC meets and discusses, how quickly they need to move, there are two key factors which they need to take into consideration. The first one is what's happening to the domestic inflation backdrop, and the second one is what's happening in the global backdrop, particularly in relation to the US Federal Reserve. So let's start with the first one, inflation. We know that the SARB is an inflation targeting central bank. They're mandated to keep inflation within a range, 3% to 6%. With the midpoint being 4.5%, the Reserve Bank knows, the MPC knows they're doing a good job if inflation over their forecast period trends around that 4.5% level. So let's think what's happened to inflation over the past few years. We haven't had an inflation problem in South Africa for a while. In fact, even in the COVID crisis, inflation not only was at the bottom of that range, but actually fell slightly below in some months in the middle of 2020. So now what we've seen recently is quite a quick rise in inflation from those very low levels back towards the upper end of the target range. So our last inflation print was 5.9%, so just under 6%. That's clearly a concern, and the SARB needs to make sure that inflation is anchored at around about 4.5%. So even though current inflation rates are higher than that, they want to send a message that inflation is going to trend back towards that midpoint again. And as we know, most economists and the SARB economists as well do anticipate that inflation will fall back to that midpoint of the range towards the end of this year, but it still is. It's quite a tricky time for the SARB, for the MPC, to keep inflation expectations well contained despite the higher near-term prints. So that's the first issue. The second issue is that not only our central bank, but central banks all over the world are very keenly focused on the US Federal Reserve right now. So we don't operate in isolation in South Africa. We know that all over the world, we saw interest rates drop like a stone during the COVID crisis to emergency levels everywhere. And then the pace of normalization from that point has been different in different parts of the world. As an example, our emerging market peers were first out of the block. So they started to increase interest rates quite quickly again after the COVID crisis. In fact, last year we saw quite significant interest rates come through for many of our peers. We saw our own MPC committee raise interest rates in November last year by 25 basis points, followed up by another 25 basis points last week. But then we have central banks like the US Federal Reserve, who hasn't even begun to tighten interest rates yet. Now, that is a particular focus area. They've done quite a U-turn in their communications from sort of middle of last year. No one was really thinking they were going to raise rates at all this year, to right now, the market's pricing in somewhere between 4 and 5 hikes by the Fed. So that's a very quick U-turn. Obviously, the problem or the challenge that they're focused on is inflation. Inflation in America and the US, 7%, highest level in 40 years, even higher than we have here in South Africa. It's a big challenge for them. They do expect inflation to fall back down during the course of the year, to end the year somewhere maybe 2.5%, so closer to their central bank target levels. But the risk they run is that inflation might actually be quite sticky in the near term. So it's a big problem that the Fed has. And our interpretation of what they need to do right now to keep their credibility intact is they need to keep all the options on the table. So whether it's changes in their balance sheets, so turning from withdrawing from quantitative easing and actually reducing their balance sheet, to interest rate increases, not just at the March meeting, which is very well flagged now, but possibly keeping every meeting live, in the coming months, possible interest rate increases being front-loaded. We think that they're going to play all of those options to be able to respond as appropriately. If inflation does start to come back down, they can ease off a little bit, but if inflation pressures remain quite intense, then they can certainly ramp up that profile a bit. So quite a bit of a year of uncertainty for the US Federal Reserve. Why does that matter for us here in South Africa? Well, if we do see an acceleration of Fed interest rate hikes, we could absolutely, as we've seen in previous episodes, we could see a risk-off period for emerging markets, which means we could see capital outflows from South Africa. If we see that, it's likely to weaken the rand, which would then feed into higher inflation prints, which our MPC would need to respond to. So that's really how the translation comes through. So taking all of these factors as they've been playing out, what message did we get from the MPC at the meeting last week? And actually, it was a very interesting meeting because the message that they sent was a lot more measured than most market participants had been expecting going into the meeting. Now, why do I say this? For a couple of reasons. The first one is that there are 5 members on the MPC committee. 4 of those members voted to hike rates, 25 basis points, but the 5th member actually voted to keep interest rates unchanged and not to hike rates at the meeting last week. That was less hawkish. People had expected a unanimous hike. And the second factor is that leading into the meeting, some market commentators are saying, we actually might have to prepare ourselves for a 0.5% increase, so not a quarter, but a full 0.5% increase. And interestingly, post the meeting, the governor did confirm to us that that wasn't even discussed at the meeting. So definitely less hawkish than the market had been anticipating. Now, why is this? The SARB is really balancing a delicate trade-off between keeping inflation expectations well anchored in the light of higher spot inflation, as well as quite a hawkish Federal Reserve. At the same time, we've got a much weaker growth recovery and growth outlook in South Africa on a relative basis, and they need to balance those two off against each other. And in fact, the concluding remark in the MPC statement was that the MPC expects a gradual rise in interest rates to be sufficient to anchor inflation expectations. So that really reflects the trade-off that they need to do. And in fact, it was quite well summarized by one of the MPC meetings, at a meeting that we had with them on Friday. He summarized it by saying, what they're doing as the MPC is they're taking their foot slightly off the gas pedal, but they're not yet hitting the brakes, which really summarizes that quite neatly for us. So, we're going into a period now where there is going to be near-term volatility. At this point in time, based on the message that MPC is sending us, we expect another 3, maybe even 4 interest rate hikes this year. What would accelerate that timing and make the SARB front load or the MPC front load their tightening cycle would be if we see a much more aggressive Fed having to respond to very sticky inflation pressures. And that risk is front and center, and certainly is the risk that all of us as fixed income managers are watching so carefully over the coming months. Thank you very much.